Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand the closing action on the D Street. Well, still about a 290 point of an uptick on the Nifty. We're above the 25,700 mark, but we've also gone past the 25,800 mark for the very first time in trade today. So the record run continues for the benchmark indices. The Nifty Bank also hit its all-time high level after a long wait now. About a 0.7% of a surge can also be seen on the Nifty Bank. As of now, there's a 420 point of an uptick at 53,474. All the sectors on the Nifty are still into the green, barring slight losses that are now coming in on the PSU banking index. So what else is buzzing? It's the auto space that is driving in top gear. You can see a 1.9% surge on the index itself. Metals, which are up by 1.5%. Realty, that's also up in trade. So all the interest rate related sectors and stocks are something that are in line, right? Remember, yesterday is when the market started to react to that US Federal Reserve's rate reduction of about 50 basis points, and the markets have continued to celebrate that again. Which are the top stocks on the Nifty right now? M&M, there's no stopping this one. 5.5% higher, it's 29.53. JSW Steel from the metals pack, 3.5% higher. Coal India, L&T, Bharti Airtel, HUL. These are the stocks that are actually top stocks in performance as far as the Nifty 50 movers are concerned. On the downside, there are just about 5 to 6 stocks which are still lower as far as the Nifty is concerned. Grasim, SBI, IndusInd Bank, TCS, Bajaj Finserv and Bajaj Finance. These are the stocks that are slightly lower in trade. Let's welcome our guest on board to really understand and what to make of the market move right now and what do we expect going forward from here. Mr. Sharad Awasthi, the head of research at Smiths, is now joining in. Warm welcome to you, sir, and thank you so much for taking the time out. Yet again, congratulations to you. Another day and another record high on the markets. But how is your overall understanding of the current market setup? Are you really happy with the kind of surge we are seeing on the index, or are you a little kind of worried about what's happening below the surface and especially in the mid and small caps?
Yeah, thank you. I think you can be a bit worried about the mid cap, small cap space, but you can't deny the fact that they are trading at peak valuations, whereas the large cap basket is not usually trading at peak valuations. So I think in terms of valuation comfort, you have some relief on the large cap side. So maybe that is what is playing out gradually. And now, after this rate cut, most probably institutions would start looking at emerging markets or developing nations more closely in a rate cut cycle. So that should play out very well, and larger institutions would largely focus on the large cap names. So maybe that is one reason that a bit of fund flow is happening into that space. But as such, I'm not unnerved. I think a bit of underperformance by mid caps and small caps in this initial part of the rally, where we rally to much higher levels by year end. I think it's a good thing to happen actually, because they have rallied very strongly and the valuations are at the peak already. So I think a bit of outperformance by large caps in the first phase of this rally, I think it should not be very surprising to most people.
Okay, Mr. Awasthi, how have you read through the US Fed's rate cut and what that could augur for the rest of the global central banks, including ours as well, and how investors should be now positioned in this rate reversal that is being seen currently? Should one stick with the rate sensitive sectors or should one stay defensive? What exactly should be one's position?
But no, I don't think you need to be too defensive right now, because within the defensive also your valuation isn't really very attractive. You don't have a lot of margin of safety. Most of the stocks are trading at their peak valuations. So I don't think within the defensive you have a lot of space to hide. But I do think that with this rate cut scenario, there is a possibility that globally most central banks, barring some maybe Japan or something else, they might not follow the same route. But the rest of the central banks will follow the same routes, and we most probably would see lower rates. I believe Philippines has done some rate reduction exercises today also. And this is something that you will see across the board. Even in India, you should start seeing that. And I think even in the US, though I was surprised positively with this 50 basis point cut, I was just yielding in around 25 basis points cut. But I think that aggression should continue. Maybe they have also realized that they have probably delayed the rate cut cycle by too long, because most of these improvement in various numbers, macroeconomic numbers, was largely the base effect kicking in because of various anomalies that kept on happening, whether they were regional geopolitical wars or disruptions on the supply side, and after COVID, what had started. So I think over the last 2 3 years, continuously, we were seeing these kind of disruptions that caused the base effect to play out. So I don't think it's very material now. Now, gradually, so coming back to your question, I think most of the central banks would be cutting rates. Defenses, I don't think you need to hide. This rally probably could be one of the most explosive rallies that we see. So it's better to participate in that and go ahead. So within banks, yeah, I think banks should certainly benefit. But I'm more bullish on the private sector side of the bank. So an HDFC, Kotak, or an IndusInd look much better vis-a-vis the public sector banks. Though Q2 onwards, most banks should report good numbers, and with this, rate cut, most probably most of the treasuries will also report very good numbers, because we have seen what 20 to 30 basis point cut, point of kind of cut on most long-term yields. So most of these bond portfolios or the treasury income part of most banks should do very well, which have not done well over the last 1.5 year, barring maybe a quarter or two somewhere in between. So I think most banks should do well because treasury income picks up. Q2 onwards, advances should also pick up. Credit quality in some cases was a bit of bother, but I don't think you should extend it too much. Right now, what I'm focusing on, I think in terms of where I see they would perform better is the private sector banks, the likes of HDFC, Kotak, and IndusInd, where I think a lot of re-rating could happen. And some of the small finance banks, I think their valuations are attractive. Most of them are trading at 0.8, 1 times price to book, because of the overhang of state elections in various states over the next 1.5 year. But I think it's a bit overdone. I don't see that to have too much of an impact there. So I think that could be one space you could look at within the BFSI space.
Okay, got it. So that's private banks definitely on top of the radar when one should be looking at. I also wanted to get a sense on the entire auto space from you, sir. M&M has surged 5.5% higher in trade at 29.56, and the entire auto space also seems to be in thick of action. What's your sense on M&M and the entire space right now with the rate cuts happening?
I think I would take the rate cuts in my normal stride. I would not bother too much about getting a re-rating on most of these stocks. Autonomous have been strong, and I think the inventory pickup over the last 2 3 months ahead of the festive season demand is something that is
Yeah.
bothering a bit. But I think over the next month or two, you would see a lot of normalization of that. The fact that most auto companies have realized it, I think over the next 2 months, you'd see a lot of deliveries happening in the festive season. So that should substantially aid, lowering of those inventories. That should be supportive to them. Typically for M&M, I think these valuations, I would say it's fairly valued. It's not valued like valued to the moon kind of situation. But I think it's fairly valued. The main trigger could be the new launches, how they pick up, like 3XO most probably had a very good launch. If two or three models further could add to that, I think they could be in a very sweet spot. The EV aggression should also be visible in the future launches. So I think it'll all depend on what the future launches do. I think raw material side pressure is not there for them over the month or the next month or two. Maybe there would be a bit of overhang of the inventory situation. But beyond that, I think people would start concentrating on what numbers these companies can report based on, future launches, new launches, basically. Currently, I think whatever numbers we are seeing across most auto companies, it's hard to find something, that you'd be very comfortable buying at these levels. So at best, expect market-linked returns for most of them, even for M&M. One or two, and there some new launch becoming very successful that could drive them higher, but nothing substantial.
Okay. Another space that's been buzzing today after a long haul is the defense space. Cochin Shipyard hitting 10% circuit. Garden Reach Shipbuilders also up about 9 odd percent. Mazagon Dock about 8 odd percent higher in trade. Looking at the surge that we are getting, of course, for Cochin, there is this FTSE rebalance and some $30 million of flows that may be expected as a key trigger. But the surge across the sector, does that point out to be the worst being behind? Most of these stocks have crashed 30-40% from their peaks. So do you actually feel now is the time to start looking at this space positively, or could this be just a dead cat bounce?
Whether a dead cat bounce or not, I would not be able to comment. But I do certainly think that this is a story that is in for the long haul. When we talk about 30-40% corrections from the highs, We also need to understand that from April till the highs, they had gone up around 2 to 3x in most cases for most of the defense and railway related stocks. So I think when you go up like that, then you create a lot of froth, and everyone seemed to understand defense. Uh, 2.5 years back, no one used to understand defense, and now you talk to any kid on the street, and he knows that defense is a great story to bet on. But we have to understand that defense is a lumpy business. It will have its ups and downs. It will not move in a linear fashion. Uh, Whether to buy right now or not, I think avoid buying when it is, going up like this. Rather try buying and picking up in lots when it is not the flavor of the month or the day particularly. So I think over the next, 10-15% kind of drop or even 20% kind of drop, you should stagger your buying, and you should only buy if you are looking to stay put into these companies for the next 5 to 6 years. I don't think the story is anywhere near over, because the offset clause kicking in and the exports maturing. I think there is a lot of opportunity that will open up for these companies over the last 1.5 2 years. We've already seen the order books well. I have no doubt that over the next 2 3 years we will again see the order books well. But to simply convert it into sales, it will not be that simple. At times, they can have a long gestation period. So that is something you need to understand, that it is not necessarily when you look at an order book, maybe you will have an earnings upgrade next year only. Maybe it is 24 months down the line. And that is something that you need to understand. And most of these companies, I think the first leg of re-rating has happened from 11 times to around 28, 25 times forward earnings. So I don't think you need to just now jump into it. It's a good re-rating, but I think I would be better off staggering it over the next 10-20% drop, where I gradually start accumulating it.
Okay. Some of the other PSU stocks, railway PSUs, housing PSUs, stocks like Hudco, stocks like IRFC, they've also broken this multi-day losing streak in trade today. And we've seen stocks surging by 8, 9 odd percent as well on an intraday basis. Should one be using this opportunity to probably exit those who were stuck at higher levels? Would you say that, or is a reversal in sight for some of these PSUs?
Uh, I think again, PSUs, it is the same story as defense. There has been a strong re-rating over the last 24-36 months. Beyond this, I think for them to move up, they will have to prove that they are worth a re-rating. And I think most businesses again have long gestation periods. They're not going to change overnight. Some changes here and there, some marginal improvement of 30-50 basis points on the margins, that can happen to any business. But I can't see anything material happening in most of the PSUs in a short time. In the long term, obviously, efficiency driven improvements could, be a big game changer. We have been talking about this since the Modi government came into power. Finally, it's playing out. So you can understand, that ideas at times can take 4 5 years to just germinate into a full-flown thing. So I think, yeah, it's fully valued at these prices. I would not be very gung ho about trying to, get into these railways, defense, or even the most of the PSU names. I think most of the rally has played out. From here on, expect market linked returns. If the markets go up by, say, 10, 15, 20%. They would also most probably move in tandem with that. Huge part of outperformance that we have seen over the last 24-36 months, I think it's largely played out. From here to get re-rated, they would have to do a lot of metal, and I don't think that can happen in a short span of time. So maybe most of them are discounting 18-24 months, so it doesn't really make much sense to rush into get into them. If you have them, I think the best thing would be to extend your horizon to 5-6 years, because I'm assuming if someone has them right now, they would have ideally bought at the recent peak, 2-3 months back. And from there, most of them would be bleeding around 30-35% on an average. So I think for them it's better to continue to hold. I don't think strategically anything changes for these companies. The type of productivity improvements they can rope in over the next 24 to 36 months could be there. And most of them have big capex plans, but obviously those capex plans need 24 to 36 months to show some results. So that is the time frame. You need to extend your time frame and stay put into that. Don't hurry to exit also, because our view is that the markets might be good over the next 1 or 2 quarters. So most of the ideas where you have probably made a mistake in the short term, you might be able to make money over the next 3 to 4 months, 6 months. So continue to hold. I don't think you should be in a rush to exit anything.
Okay, don't be in a rush to exit anything. IRFC is up by 4%. Several other stocks from the railway pack are also up and about. Texmaco Rail has shot up in trade. You have Railtel that's up by over 6%. You have Rights that's also jumped by over 9% in trade today. Then you have Ircon that's also buzzing in trade. The entire space seems to be having some traction coming in, but you'll have to wait patiently. There's a long-term story that will be unfolding, and don't be in a hurry to exit in case your entry levels is much higher than what it is right now as well. That's what the view is coming in. Okay, sir, you did talk about how banks are something which are on your radar. HDFC, IndusInd, Kotak is something that you marked as well. 3.8% higher for ICICI Bank. It's at a fresh record high. Is there a reason you're leaving that out?
Yeah, I think for ICICI Bank, the re-rating story has played out very nicely over the, since COVID. I think the management change worked wonderfully for them. The way they have transformed the bank and the working culture has been remarkable. And that was visible in the valuation multiples the bank is getting right now. I think so. Most part of the re-rating is over. I don't see re-rating triggers coming in ICICI Bank. I think most of the re-rating has already been done. And now you can expect market-linked returns. For HDFC, Kotak, I think there is a possibility of a lot of re-rating happening, and most probably once they start rolling in those numbers, there is a possibility that the price to book multiples could be revised higher. Even the earnings trajectory could be revised higher. So I think both those banks could be catching up on a lot of lost ground. So that will result in a lot of re-rating. Both have different strategies. One is the M&A strategy leading to an aggressive growth path that should yield some results. Kotak has a different strategy, a change of hands at the top. I think people are trying to put in a new Gen Z kind of focused approach that could yield results. So I think those two are that kind of story. IndusInd, I think you have the most largest valuation comfort. I think it is one of the cheapest private sector banks right now. Even if it normalizes in terms of valuation, you could see 400, 500 rupee kind of upside there. So that is why IndusInd. So I think the combination of these three is based on the fact that two could get re-rated very strongly, and they are very strong franchises. And IndusInd, I think the valuation multiple gives you to something that offers a lot of safety at these prices. Even a reversal to its mean multiple could mean 30-35% kind of further upside. So that is why I've chosen these three, and I have avoided Axis and ICICI. Most of the re-rating is over, and Axis also, I think it's roughly fairly valued at these prices. Maybe you would have another 5-10% upside too, according to my target prices. So I am expecting that most probably Kotak, HDFC, and IndusInd would outperform the rest of the pack.
Okay, got it. So that's as far as the private banks are concerned. Let's shift gears, get you to talk about the top mover on the Nifty Next 50. It's Zomato, now at a fresh record highs, 292, a 4.7% surge is what we have seen. And this story continues to surprise many. The stock has already more than doubled in this year so far. And if we look at the kind of returns year to date you have seen is to the tune of 135% nearly on Zomato. And of course, there is this entire buzz now that probably Swiggy will be, coming out with its IPO very, very soon. It could be filing in its DRHP papers also soon as well. Your own sense, Mr. Vasti, on this food delivery space, internet-based space as well. Competition is going to probably soon increase on the D Street as well. Two of the marquee players within this space will now be competing not just on the ground but also on the street for stock performance and share gains as well. How would you be really looking at Zomato story now?
Uh, yeah, I would not be very keen to invest into Zomato. I think, yeah, it's an excellent story, excellent business. The way they have performed in terms of the business growing, the Blinkit acquisition, I think everything's been fantastic.
Yeah.
But when you ask the question, how much do you pay for such a fantastic business which has turned it
Yeah.
around? I think I'm not willing to pay the moon for that business. So it's already trading at what, 10 times forward EV to sales. Next 2-3 years, yeah, 11 times. Next 2-3 years, the growth rates would be very good. But what are you looking at? FY26 earnings of somewhere around 5. Maybe it gets re-rated by then because there has been some re-rating. But even considering 5-6 rupees, you are trading at what? 60, 70 times 3 year, 2.5 year forward. I think that's a bit absurd. I think most of the positives might be priced in. But with the caveat that I felt it was expensive even for 200 for 70, $80, but it's 280 right now. So I think these are stories, where you are building too much into the hype of what would happen, because this is a disruptive space. And once you have established a business model, I think many newcomers can come in. Some of the smaller hotel chains, they have their own delivery thing, and they don't want to depend on Zomato. But a large part of the market does depend on them. So I think more and more monetization is happening. I think eating outside or ordering food at home is a trend that will continue to happen. But will it be linear in nature the way it has caught up in the recent past? Will it continue like that over the next 24, 36, 15, 16 months? I seriously doubt it. I think everything goes through a chain where have a J or J stick kind, hockey stick kind of recovery or growth. For Zomato, I think we have seen that first leg where people got a knack of getting food ordered at home. But beyond the point, it will slow down. I think right now to expect this to move in a linear fashion, even home deliveries. I think yeah, initially when you get a service, obviously there is a hockey stick kind of movement. The same happened with Jubilant or the pizza, Domino's pizza for quite some time, and people hoped that a lot of magic would happen and you continue to eat pizza at a phenomenal rate. But beyond this initial cliff, you usually slow down. So I think this is something that will happen to these businesses also. But being a new business, being the performance over the last 1.5 year has been phenomenal. The new acquisitions have been good. But at these valuations, I would rather ask myself whether I'm willing to pay these kind of absurd valuations for even a fantastic company growing at a fantastic rate and a very good business, obviously, which has proven itself over the last 2, 3 years. It is something that we need in the urban ecosystem. But I would not be willing to buy it at these valuations. I think it's rather better to get into something which is available at a better valuation. And I think over the next 1.5, 2 years, you'll get it at much better valuations than this. So I would rather give it a pass.
Okay, give it a pass, but the markets are soaring further higher. Viewers, in the last few minutes, we've again seen markets retest that intraday high level and go past it as well. So 25,822 is what we briefly touched, and that's the fresh record high level in the markets now. Remember, the Sensex is beyond 84,600 mark as well. So we are seeing a very sharp bound of buying in the markets right now across the board. All sectors up in the green. On the Nifty, I think it's just barring few stocks, just about 5 stocks. Rest of the stocks are all up and about. The broader markets are throwing in many names that are up in double digits. Stocks like ITD Cementation, Concord Biotech is 17% higher. Marksons Pharma is 18.5% higher in trade. Mrs. Bector's Food is up 13% in trade. You have Prism Johnson that's buzzing. Then you also have stocks like Phoenix Mills from the real estate retail space that's also buzzing in trade. Tube Investments, Vatek Wabag. We've discussed the railways and the defense stories, so most of these stocks are also going up. You have Asahi India Glass that's up almost 10%. You also have Max Healthcare. That's also up by 8.5%. Those are the kind of gains that we are seeing all across. So Sensex, Nifty, Nifty Bank, all three of them at record high levels. Let's get Mr. Awasthi to talk about what do you think are the key reasons why the markets are soaring higher on the benchmark index level, and more importantly, will it be sustainable in the next week too?
1 week or not is a difficult call for me to take. But I do certainly think that with a lower rate cut trajectory, you'd see higher inflows into emerging markets, as I told you earlier. And with that kind of flow materializing, I think domestic inflows have anyway been strong. So combine that with international flows coming back, you could be looking at a much larger rally over the next, 3, 4 months. And in the initial phase, maybe the fast moving money might not come in. But once the rally starts to emanate, I think a lot of fast moving money on the international shores will also start coming in. So that should culminate into a very strong rally over the next, 3, 4 months. And I don't think next week should be anything different to that.
Okay, the real estate story is going even more strong now. The Nifty Realty Index is 4% higher in trade right now. A strong surge on Phoenix Mills, like I pointed out, 10.5% higher for the stock. Macrotech Developers is 7.5% higher. Sobha Limited is about 7% higher. 4% uptick for DLF. Godrej Properties up 3%. Oberoi Realty up 2. Suntec Realty up 3% as well. How are you looking at this strong surge in the real estate story now unfold, sir? And what do you foresee? Look at the Nifty, keep an eye out on their viewers, 25,823. We are further surging up as we inch closer to the last 6 minutes of trade as well. It's the real estate space that's buzzing now. Mr. Avasti.
Yeah, I think it's a very good long-term story if you look at it. Means if you are planning for 4 to 5 year kind of horizon, I think it could be a very good place to bet on. In the short term, maybe 1.5, 2 years, most of the stocks might be priced to perfection, not leaving much on the table. But long term, I do certainly believe that this, and sentimentally, obviously, rate cuts make it look better in terms of share market parlance. A lot of short term money starts to move in. But in terms of long term, I think the valuations at which they are trading, they leave very little scope on the table. Maybe one of the smaller companies, Shriram Properties, valuations are attractive that I remember. And among the larger players, maybe Oberoi Reality, at 10 times, 20 times EV beta 1 year forward would be one of the cheapest option. Shobha, Loda, but these are companies that have run up over the last, few 6, 9, 12 months. So I don't think they offer much upside from current levels. But sentiment wise, yeah, I think expect market linked returns from them as well. I think sentiment would continue to remain positive in terms of quarterly numbers. We are not seeing any kind of slowdown in terms of launches, in terms of bookings. So I think that traction should continue. And in the long term, it's an excellent story to bet on. But maybe 18 to 24 months, you need to look at companies where you have some kind of valuation.
Okay, got it. For the first time, viewers, the Nifty Bank has gone past 54,000 mark as well. All the three major indices are at record high levels for you. There's a strong momentum unfolding in front of our screens. We're now seeing the Nifty hit a fresh high of 25,831. That was the intraday high that we have seen, and the markets may actually be just 4 minutes to the close, maybe looking to close above that 25,800 mark. That will be, of course, no point for saying that record closing higher for the markets. A 400 point of a surge on this one, and about a 1400 point surge on the Sensex as well. The Nifty Bank up by 1.7%. That's a 900 point surge. Remember, as far as the markets are concerned, the investors have really garnered about 6 to 7 lakh crore rupees of gain in market cap as of BSE is concerned towards the end of the session now. Mr. Avasti, looking at these dizzying levels on the markets, are you also worried about the expensive valuations that we are at? That's something that we have to continue to keep an eye out on, even though there is some kind of an enthusiasm that's buzzing back home with the macro changes across the world, and flows may be coming in, but will valuations now dent sentiments at some point?
See, valuations usually do not dent very positive flow kind of sentiments. So right now we are talking about very positive flows, and I don't think there is something in the near future where the domestic inflows would slow down substantially. Uh, if a geopolitical even internationally does emanate into something very big, that is something that could cause some trouble or a big collapse of some financial system. But other than that, I think what I look at right now is I can't perceive any kind of big risk coming out over the next 3 to 6 months. Uh, Beyond that, yeah, maybe something does culminate into a black swan kind of event. But before that, I don't think you should be too nervous about it. Obviously, when you're sitting at all-time highs and you're sitting at an year-end rally, maybe a fag end of a big cyclical rally. So there is always that risk that you're taking. So sit on 20-25% cash, as we have spoken earlier. Rest of the portfolio should continue to participate in the bull run. I think we still have some leg, and usually the last legs are one of the most profitable legs for any market rally.
Okay, got it. Well, on that note, thank you so much, Mr. Avasti, and congratulations yet again for seeing this historic moment unfold in front of you. Record highs for the markets, and we hope the momentum sustains going forward from here. We are just about a minute away from the close, and we are looking at an above close of 25,800. Record highs coming in front of you as we speak. This is for the first time you're seeing 25,830 odd levels being seen. 25,849 was the intraday high that for a very brief moment that Nifty hit. Over 400 points of a gain coming in. A strong surge on the Nifty Bank, 922 points higher. We also have all the sectors buzzing. The real estate sector really took it away towards the end of the session, almost 4% higher. Auto space 2% up. Financial services up 2%. Private banks up 2%. Nifty Bank overall up by 1.7%. You have metals that were shining brightest, 1.6% higher. I think all of the sectors have been buzzing with at least 1% gains. Small caps and the mid caps are also recovering, 1.5% higher for the mid caps, and the small caps also end the day with 1.3% gains. Top movers on the Nifty are M&M, ICICI Bank, JSW Steel, L&T, Coal India, Bharti Airtel, and on the downside you do have some stocks that could not participate into the rally today. 5 to be specific about: Grasim, SBI, IndusInd Bank, Hero Moto and TCS. But it's a Friday, viewers, with over a 400 point rally on the Nifty, 25,818. It couldn't have been a better end to this very, very volatile sort of a week that we have seen thus far. But let's hope with this there is further hope that the momentum could continue. Record high levels coming in. All eyes are now on 26,000 as to when that could be coming in on the markets, and I don't think the markets will be testing too much patience beyond that, because we've entered the bright festive season as well. We'll wrap it up at that on markets today, viewers. Many thanks for being with us on this special edition, but do stay tuned. We'll be continuing to get you all the news and updates from the world of business, even beyond the stock market hours. Thanks a lot for tuning in. For now. Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is your favorite show, Daily Calls, a show that addresses all your stock specific questions. Now, in case you're watching this show for the first time, over the next 50 minutes, top market experts will answer